Hi, I'm Alex Davies, founder of Wealth Club, and with me today is Oliver Bedford of Hargreave Hale. Hello, Oliver.
Hi, Alex.
First off, perhaps you could just give me a brief background into Hargreave Hale and who they are and what they do.
So Hargreave Hale was founded in 1897, and over the years it's developed into a sort of vertically integrated full-service stockbroker and fund management company. We hold 6 discretionary mandates over unit trusts, including the Multiple Situation Fund, the Multiple UK Microcap Fund, and the Multi-Cap Income Fund, also from Marlborough. And that's obviously done in addition to the 2 AIM VCTs. We've been a private company up until very recently. We were acquired by Canaccord Genuity in September this year, so we are ourselves now embarking on a new exciting sort of journey.
Okay, and the Hargreave Hale AIM VCTs, what do they do for investors?
We aim to provide a mixture of capital growth and income to our shareholders. We do that through a diversified portfolio of small UK companies. Primarily those companies are listed on AIM, although our mandate allows us to make a limited number of investments into private companies.
Okay, and what would you say makes you and Hargreave Hale qualified to do this?
We've got a very large fund management team of 15 fund managers. I think it's probably the largest in the UK small cap space. That allows us to meet many small companies. So we hold up to 1,500 meetings a year. It gives us great insight into the market.
Perhaps we'll just turn to the investments. What sort of companies are you looking for?
I think the first point is it's important to be open-minded to any company that comes to see us. So we're very much, we'll take every individual story as it comes. I think what's important, particularly when viewed in the context of AIM, is that, and within growth equity generally speaking, is that the characteristics that define a successful company, issues such as the quality of the management team, their intellectual property, their pricing power, secular growth in their own markets, all of these features are unique to any successful company. It doesn't really matter if they're on the main market or on AIM, or for that matter, a private company.
So are there any particular favourite stocks you have at the moment, or just maybe companies you've recently invested in that you would like to talk about?
So we've been building an exposure into e-commerce and the on-demand economy. We like the innovation and the growth within that space. We like the way they are promoting consumer choice and convenience, that they're disrupting mature and established industries. Some examples of recent investments would be Honest Brew. That is a craft beer e-commerce platform that is bringing distribution to brands, or essentially connecting consumers and small brands in a way they wouldn't otherwise be able to do so. We've also recently invested in a company called Gusto. That's a food recipe kit business which provides pre-proportioned menus to the consumer in a very flexible and efficient way.
Okay, and are there any sort of types of companies you just don't like, you wouldn't touch?
I think one has to be careful about sort of making those sort of wholesale decisions to move away from a sector, because well-executed growth stories can thrive even in a challenging market. And certainly we've had many examples of companies where either they don't appear to be particularly special on first review, or they've got a bad backstory, and yet they develop into very successful and exciting companies in a way perhaps we didn't first anticipate.
And if we look at exits you've made, any particularly successful exits?
We don't really tend to talk about exits within our team. We've had some very successful investments which we continue to hold equity in. So Abcam was is the most successful company. We've been in it for 12 years or so now, and the return is around about 30x on the initial entry price. So it's been very good. On the private market side, we were in an exciting contact lens business called Vision Direct, which dominates the UK market. And we made a substantial exit from that a few years ago. But generally speaking, we're entering into these investments with the intention of being, a long-term shareholder. We don't really look to sell good companies. They're not always particularly easy to find in the first instance, and we like to hold on to them, allow our portfolio to develop a core collection of companies that are established, mature, profitable companies that we can depend upon and hopefully drive returns to our shareholders.
Are you finding it harder to get deals? And of course, also there's a lot of money just chasing AIM stocks because of the inheritance tax benefits.
Although well, firstly, we didn't really come across the IHT players very much. They do invest in the same companies as us, but they tend to appear on the shareholder register sometime after we've made an entry. Growth in EIS has also been a factor. I think what is the case is that the most exciting stories when they come to market are always highly sought after, and it's difficult to get good allocations into those. But that's true for any fund manager. It's not just an issue for an AIM VCT manager. We last year made 25 investments into qualifying companies. That was an increase of 50% year on year in the amount of capital that we deployed. And this year we've already surpassed what we did in 2016. So for the time being, we seem to be in a good place for deal flow.
When I look to invest in VCTs each year, I'll generally choose 5 or 6. And I have to admit, first off, I'll always go to the generalist section, and in a way, AIM is often the afterthought. So why should investors choose an AIM VCT?
I think there are two issues here. One is that AIM is a misunderstood market. It has at times attracted some negative press, but it's a very large market. It's a home to over 1,000 companies. And whilst, of course, we come across companies who have challenges or have examples of poor governance, but the inverse is also true. And AIM has developed many companies that have gone on to become global leaders or well-known household names. And good examples would be things like Asos or Boohoo, Abcam, and Fevertree. So AIM is really, for us, is where we go looking for deal flow. It's a large market. It's underpenetrated by the sell-side community and misunderstood. And that really makes it times for an inefficient market. And as active investors, inefficient markets work in our favor. So I think the first point is to just understand AIM is home to many exciting, fast-growing, dynamic companies. And it's great to get an opportunity to invest in them. I think the second point is that AIM, certainly after the financial crisis, for several years, it was unpopular within investors and with their advisors. And I think that's starting to change for 3 reasons. The first is this point about a number of companies emerging and becoming well-known. Secondly is the way that AIM IHT and AIM ISAs have increased the number of touch points for investors and their advisors, and they've become more comfortable with it. And the third point is just performance of funds and products on AIM has generally been good over the last few years. And so people have been able to see, if you like, or validate the principle of risk and return. Of course, investing in AIM is high risk, or many of the companies are high risk. But for those people who can tolerate that risk and who are able to invest for the medium and long term and potentially ride out any market cyclicality, then as you would expect, really, investments into small companies ought to deliver superior returns when held for the medium and longer term, and that's true for AIM as much for any market. And
you rightly say it is risky. What do you do to mitigate those risks?
We have a number of approaches, and which we apply or can apply. The first is and this is true for all of our fund mandates at Hargreave Hale, we favour diversification. So we, generally speaking, don't let positions become too big. I think there's a wealth of opportunity to find new investment, and we don't feel any particular need to allow companies to become overweight within the portfolios. So small companies are inherently vulnerable. They don't have necessarily a depth of management team. So it's important to mitigate against sort of black swan events. They're not as well positioned to ride that out if it occurs. So that's within, obviously, the qualifying investments. But then also at the sort of the fund level, we diversify too. So we have at times had very material exposures to fixed income and cash. It's been a very profitable strategy for us in the past. I don't see too much opportunity for us right now in that area, but we keep an eye on it. I think what is true is we manage risk quite proactively, and we're able to move in and out of equity risk surprisingly quickly, actually.
Finally, I'm going to invest in a few VCTs this year. Why should I choose yours?
I think with a large team of 15, we have considerable reach into the market, and we're able to hold more than 1,500 meetings annually with small British companies. And that gives us a level of insight which is hard to replicate through other means such as desktop research. We've been managing small cap money since 1998, so we're very familiar now. We've built up a lot of experience, and if you were to aggregate the amount of time across the fund management team, we've now got more than 250 years of collective experience investing into small UK companies. That's important because when you're looking at investing in small companies, it's an art as much as it is a science, and it's important to be able to bring experience to bear when you're trying to evaluate that trade-off between risk and reward.
Oliver Bedford of Hargreave Hale, thank you very much.
Thank you.